So, I think we finished up the revenue cycle on Tuesday, right? Yeah. So, the expenditure cycle, most of what we're going to cover is basically the same thing because the audit approach isn't going to change, right? We're still going to identify, based on our planning, where the risk is in that particular cycle, what accounts are considered to be have a greater probability of risk of material misstatement. So we're going to look, and depending on how we assess controls in this area will depend on the nature of the audit testing that we perform. So if we decided that we could rely on internal controls as a result of doing our control risk assessment, then we're going to spend more time testing controls and the related transactions, and then reduce the amount of substantive testing that we do. So it's the same approach, right? It's just that the accounts that are in this cycle will be different from the accounts in the revenue cycle, except for cash. And the controls are going to be, obviously the controls are going to be driven by the types of transactions that result in this business cycle. So I'll probably go through this with a little less detail than I did with the revenue cycle because, as I said, the approach is basically the same. So when we're talking about the acquisition and expenditure cycle, we're actually obviously talking about the process that the company has in place to acquire goods and then to pay those goods that they acquire. So normally what we're going to see in this cycle, in summary, is this purchasing process, right? Processing purchase orders that we send to vendors, and then what are the controls around that? That then leads to the receiving of goods and services and the particular controls around that. And what's really important with the receiving of goods and services is the fact that when we receive those goods, it triggers a liability, right? It triggers that the company should recognize a liability for those goods and services. So we want to see really good controls around this because this results in a liability and an expense. Right? So we want to see really good controls around this. And then once we recognize that liability, we have to pay for it. So controls around cash disbursement. So let's look at the particular functions in a minute. But so the major functions in this cycle would involve things like the purchase requisition. And so a purchase requisition is what the user department sends to the purchasing department to request or initiate a purchase. Right? That function is usually separate from the purchasing department. So users will not have the ability to outright purchase goods. In some organizations, they have to go through the purchasing department. So they'll issue a purchase requisition. There should be controls around that, such as there should be a signature for that. That has to be approved, a purchase requisition, and not anyone can just issue a purchase requisition. It has to go through an approval process. That purchase requisition then goes to the purchasing department. And the purchasing department, based on that approved requisition, will initiate a purchase order. So a purchase requisition is very different from a purchase order because a purchase order, and that's what we mean by purchasing, a purchase order will commit the company to purchasing goods, right? It's similar to it's a contract, right? So the company then draws up the purchase order and issues that purchase order to the vendor, right? So we want to purchase X amount of widgets, and this is, this is what we would like to purchase, the amount that we like to purchase. Once that purchase goes to the vendor fills the purchase, sends it to the company, and that's where receiving comes in. So we want to see really good controls around receiving because that is what will trigger the recording of the liability. So you want to make sure things like that the purchase, that you're receiving something that was authorized. The purchase order is indication that it's a valid purchase, or that you're supposed to receive those goods, right? So you would look to ensure that a control would be that purchase receiving orders are matched to purchase orders, right? so that when they receive the goods, before they take custody of those goods, they should make sure that there's an approved purchase order. Because you don't want to take custody of goods that were not ordered by the company. The receiving report should then be a copy of the receiving report should go to accounts payable, so that accounts payable will match it with invoices that they receive, right? Because you can imagine that the vendor's probably going to, ship the goods, and then they're going to send the invoice to accounts payable. Well, accounts payable shouldn't pay on an invoice unless they know that we received the goods, that we're paying for something that we actually received. So accounts payable should have a copy of the receiving report, so that when they're processing the invoices, they'll match this against the receiving report. So that's a valid purchase. And disbursements, as it says, it relates to the cash disbursement. And so one of the key controls, a standard control that you expect to see with respect to disbursements, is that a cash disbursement is supported by a purchase order, a receiving report, and a vendor invoice. That's what we call a three-way match. So you'll hear that term used, a three-way. So that is what authorizes that disbursement. One, that you're paying for something that you've been billed for, that you received, and that was authorized. The purchase order is indication of authorization to make that purchase. The receiving report is indication that we actually did receive these goods, and the invoice is indication that we were billed for the goods that we received. So when we look at a disbursement package, and sometimes you will see here referred to as a voucher package, in that voucher package, there should be evidence of those three things, those three documents. And then accounts payable and the general ledger are exactly what they suggest. One is the detailed file of accounts payable, liability, and the general ledger is the master account. It contains a master account for accounts payable. Some of the documents that you will see in this cycle, I already talked about what a purchase requisition is. That's issued by the user department. Purchase order is issued by the purchasing department to the vendor, whereas the purchasing requisition comes from the user department and goes to the purchasing department. The receiving report is what the warehouse fills out, or the distribution center, what they fill out. So the company, this is an internal. All three of these are internal documents. The receiving report evidence is that the goods were received. The vendor invoices, obviously a third-party document. The check or disbursement actually is the company's payment of the invoice, and then the account payable master file is the detail of your accounts payable, and the cash disbursements master file is the detail of your cash disbursements. Right? So these things, these master files, the detailed information, you want to see that there's reconciliation to the master accounts. So those are the typical documents and records you see in this cycle. I want to talk a little bit about inherent risks related to this cycle, and you can look at Exhibit A2 for more detailed discussion. But basically, what you're concerned with is unreported liabilities in this cycle. Why do you think that that is important in this cycle? Why would that be the auditor's focus? Why would that be an inherent risk?
Because the company is more profitable, or
possibly, right? So if a company is trying to look more profitable, in other words, they're trying to manage earnings, one way that you do that, right? Because most times when companies are trying to manage their earnings, they're trying to manage income, right? So they're trying to manage net income. And one way to manage net income would be to reduce your expenses, right? So if you do not report an expense, then obviously your net income will be higher. So, and think about when we report a liability, we're reporting an expense, right? Because it's you debit and you receive inventory, not inventory, you pay rent, right? So you debit rent expense, you credit accounts payable for some type of liability, or you purchase goods. You debit, you would debit miscellaneous goods, and credit accounts payable. So when you record your liability, if you don't record the liability, you're not recording an expense related to that liability, right? So therefore, your net income would be low. So auditors would look for unreported liabilities. So what assertion do you think that relates to? Right. Completeness, right? Everything that should be reported, it has indeed been reported. So the completeness assertion is a greater focus in the audit of expenditures, right? Acquisition and expenditures, whereas we saw the higher risk assertion related to occurrence with revenue, right? Because you're not normally concerned about understatement of revenue, you're more concerned about overstatement of revenue, and vice versa, you're more concerned about the higher risk is with understatement of liabilities. Right? So unreported, and we'll talk about some tests, the audit test, the auditors perform for that. Also, a company can have purchase agreements that payment clauses they can't be canceled, so they have to abide by the purchase, so they have to purchase the goods. And so you want to look at those types of agreements because a lot of times, the company might have to report a liability for those types of agreements. And so the auditor would look through, will obviously inquire by talking to management about this, but also look through contracts, board minutes, for example, to determine if there are any of these types of agreements that exist. And then another risk is capitalizing expenses, right? And so we saw that actually with WorldCom. That was one of the practices that WorldCom was using to manage earnings, is that they were capitalizing the expense, repairs and maintenance on the balance sheet, and we all know that that's not GAAP, right? GAAP is that you expense those types of expenditures or those types of expenses, and so again, it has the impact of boosting your assets, but and boosting your net income, right? So you look for those. Those are some inherent risks associated with this cycle. Other types of evidence that auditors will look for would be things like the open purchase order file. And here you want to look at what the concern is that there are actually purchases that have been received, but for some reason they haven't recognized that the purchase has been received already. The order has been received, right? Because it's not, unless something is on back order, it's unusual that a purchase order would be open for a long period of time. So I'm not talking about looking at open purchase orders that have been outstanding for maybe a week, but maybe if it's been outstanding for a significant month, 2 weeks, 3 weeks, maybe the auditor would look at the auditor should probably inquire about why those purchase orders are still outstanding, because it's unusual for things to be on back order that long. But it's a red flag. So and obviously, if the goods have been received and they haven't updated the purchase order file, there's a chance that they haven't reported the liability. So again, you're looking at this to determine if there are any unreported liabilities. Same thing with, so also looking at unmatched receiving reports, because that could be indicative of items received that were not authorized. Right? So there's no corresponding purchase order. And so that's a breakdown in internal controls. It might be indicative of fraudulent activity. So those are things that the auditor wants to look at. Unmatched vendor invoices could point to a problem that the item wasn't reported as a liability, that the liability has, the accounts payable hasn't been reported, or again, it could mean that it was an unauthorized purchase, because the fact that it's unmatched means that you either haven't identified the receiving report or the purchase order associated with it. Other things they look at, you'll see accounts payable or voucher payable used interchangeably. It means the same thing. The trial balance is exactly what it suggests. It's a detailed listing journal records all of the purchases that the company has made. And so auditors would use these to, for example, if they're going to test controls and they want to look at controls over purchasing, they would select a sample of purchases from the purchasing journal and ensure that the control associated that they're testing is indeed working effectively as described. Fixed assets also fall under this in this business cycle, and so auditors will look at the fixed asset reports as well. As I said before, the approach doesn't change, right? So same approach that we took with the revenue cycle. You have to understand your internal controls, and the reason that you're trying to understand that it's important to understand internal controls is because you have to assess control risk. And by assessing control risk, that determines the extent of testing of internal controls we're going to do. So just to reiterate, if controls are effective, then we're going to, the nature of our testing will consist more of test of controls, right? Because we can rely on internal controls. If we can't, if we assess control risk is high, that means that we can't rely on internal controls. So if you can't rely on internal controls, you're not going to test it. So the same approach we talked about over the last couple of weeks. Some key functions and duties. Remember, segregation of duties is really important. And it's an important control activity. And so the auditor is going to want to ensure that there's appropriate segregation of duties in this business cycle. So for example, the purchasing function should be segregated from the requisitioning and receiving functions. Right? So that's why you see that customers and companies, they will have the user department requisition goods and send the requisition goods and send it to the purchase order, the purchasing department, so that the purchase can be filled. Now, there are some instances where the user department can indeed purchase goods. Right? And so what most companies will do, it will be for lower dollar amounts, things like office supplies. So a company might say, okay, each department has a budget and they can purchase certain types of goods within this budget. But they have to purchase from an approved vendor. So we're only purchasing from this particular vendor for these goods. So for example, office supplies. Most companies will set up that in their departments because you don't necessarily want to have a purchasing department for purchasing things like office supplies. First of all, it's not going to be very significant. And it's lower risk, right? So you'll have them maybe you'll set up a vendor account with Staples or I don't know, Office Depot, something like that, right? And so that person, the department head or administrative assistant in that department know that they can only purchase goods from Staples related to office supplies. There's already, so the purchasing department has already conducted a, the negotiation with Staples. They've negotiated the prices, and also it's built into the system that purchases can't exceed a certain dollar amount, so that it limits the person's purchasing authority, so that it's not significant. So those are some instances where you will see a user department is able to go to purchase goods. It's going to be low risk, low, not significant amounts of dollar purchases that they can do that. Obviously, you want to separate from the receiving department, because if a person holds all three of these functions, they can order goods and approve it and steal the goods. Right? The invoice processing function should be segregated from the accounts payable function. So the person who's responsible for invoice processing want to make sure that they can't process goods at the wrong price or terms, or process a cash disbursement for something that has not been received. So in other words, they have their buddy, their friend, cousin, brother, submit a fictitious invoice, goods were received, but there's an invoice. The disbursement function should be segregated from the accounts payable function. The individual who would be responsible for the disbursement function should also have access to the accounts payable records, right? They can make an unauthorized check, supported by fictitious documents, and they could update the records to reflect that. So they have the ability to commit an error or fraud and cover it up. And then finally, the accounts payable function should be segregated from the general ledger function, right? Because in this case, you don't want that person responsible for updating the accounting records and the general ledger, because then they can steal, cover up any errors or fraud that would normally be detected by reconciling the subsidiary records with the general ledger records. So you want to, again, so it's the same segregation of duties, you know, custody of assets from updating the records. Okay? The same concept. It's just that we're looking at this with respect to the expenditure cycle and what functions are a part of this expenditure cycle. If you turn to Appendix 8A in Chapter A, is at the end of the chapter. It is on page 8A1. It's on page 355. So what Appendix 8A represents is an internal control questionnaire. And this is a standard document that the auditors will use. So this is an example of an audit document that auditors will use to guide them in their assessment of the internal controls. So you'll see that these are in the form of yes/no questions. And clearly, if they answer no, there should be some comment as to why. So you would look at these to determine whether or not control, this gives you some indication of where there will be, where there might be internal control issues. Okay. So you'll notice that it's broken down by assertion, right? So for example, under accountants, audit purchasing department, accounting department, receiving department, and shipping department independent of each other. So that's getting at the control activity of segregation of duty, right? So clearly, if the auditor answers no, if the answer is no, this is an issue, right? This is a control weakness. And then the auditor has to assess what the impact of it is. Then you see things like completeness. Are the purchase order forms pre-numbered and the numerical sequence checked for missing documents? So remember, one of the things I told you about is when you see something pre-numbered, checking the sequence, we're getting at the assertion related to completeness. That all of the documents are accounted for, that you can account for all of the transactions that occurred in that reporting period. So when auditors are looking at control procedures, they're looking at 3 different types: the information processing controls. So that's the information processing over transactions that flow through the AIS system. Physical controls, meaning those controls over custody of assets, over access to assets. And then performance reviews, meaning things such as reconciliations, performing the reconciliations and reviewing the reconciliations. So then if you look on 8A4, which is on page 357, same idea, internal control questionnaire, except this questionnaire deals with the property, plant, and equipment. So transactions related to PP&E. So those are 2 standard types of internal control questionnaires. You also see in 8A2, those are dealing with computerized questionnaires. So you'll see, and we'll talk about information technology probably in a week or 2, but dealing with controls around the information processing, things that are transactions, how the input, processing, and output of transactions that are flowing through accounting information systems, and it's broken down between general controls and application controls. I won't get into those now, but we'll talk more about those when we talk about information technology in the audit. Management assertions, same idea. So if you turn to, I'll walk through a couple of those. Assertions about transactions, if you look at Exhibit 84 on page 329. So the assertions about transactions are the same assertions that we talked about when we first talked about assertions related to transactions, as well as when we revisited those assertions in the revenue process. So you have the same assertions, it's just what your audit objectives are going to be different related to that. So the audit test that you perform is going to be different. So, for example, under currency purchases and related events that have been reported, have occurred and pertain to the entity. Right? So they're valid purchases. Controls will be things like the separation of duties, that purchase orders are supported by invoices, existence of receiving documents for all invoices, those types of things. Testing controls, you observe, for example, segregation of duties, review and reconcile a voucher package for purchase order, receiving report, and invoice, check documents with the correct customer name, product description, terms, dates. So those are some control procedures that auditors, control tests that auditors will perform. Completeness, as I indicated before, is one of the critical assertions in this cycle. All purchases that should be reported have been reported. All liabilities that should be reported have been reported. Are there pre-numbered documents? Looking at the receiving report and tracing that to the recording in the purchasing journal, right? Because the receiving report is evidence that the goods came in, that you received something, right? You received goods, and assuming that the appropriate controls existed around receiving, then you would update, that receiving report would update the purchasing and liability accounts. Accuracy, cutoff, again, cutoff deals with that it's reported in the right period. Right? So you would look at, for example, looking at the date of receipt to the date reported in the voucher package, right, or the voucher journal, accounts payable voucher journal. Inspect evidence that the client is ensuring that the dates are consistent. And then, so those are the assertions about transactions and events. So again, the assertions don't change. It's just the documentation and controls that you're looking at that's going to change around those assertions. And then if you turn to 8.6, Exhibit 8.6, which is on page 322, that deals with assertions about account balances. So in other words, those items on the balance sheet. And so again, here you'll see existence, rights and obligations, completeness, valuation, and allocation. So really, are you going to see confirmation of accounts payable? So unlike confirmation of accounts receivable, confirmation of accounts payable are not required. So auditors do not, the standards say nothing about confirming accounts receivable. It's not required. It's an auditor judgment decision as to whether they confirm accounts payable. And as you'll note here in the text, if it's a high-risk accounts payable, they might confirm it. So they might look at high-risk payables and make a decision to confirm those payables, but they do not have to confirm to test existence. Instead, they can vouch the reported payables to vendor invoices, receiving reports, and purchase orders, right? Because the vendor invoice indicates that you will bill. The receiving report indicates that you will bill for something that you actually received, and the purchase order is indication that it's an authorized purchase. Right? So that gives you information about the existence of that payable, that liability. Rights and obligations mean the same thing. The company should only in trade accounts payable or trade liabilities do you want to see that the company has it's a liability that the company incurred, right? That the company generated that liability for things like purchases of goods. And completeness is exactly what it suggests. With valuation, unlike the allowance for doubtful accounts, it's unlikely that you're going to have the allowance for doubtful accounts payable because the company is responsible for paying. So they're not going to set up an allowance account for accounts payable. So instead, when we talk about valuation here, what you're seeing mostly is that the amounts that are reported correctly. Now, one thing that you might see that would really be covered here, right? Because we're talking about liabilities, would be something like warranties, a warranty reserve, right? So that's a liability in the sense that the company's established a reserve to cover return, goods that might be recalled or goods still under warranty. So they set up a reserve to cover that, right? So they debit warranty expense and credit the reserve in setting that up. So you would look at and most times, right, because it's not as though when you set up the reserve, you're estimating what you expect the return or goods to be that will be goods that will be processed for against that warranty reserve. So it's an estimate, right? Because not every product that you sell is going to have to take advantage of the warranty on it, right? So not all because if all your products are problematic, then people are just going to stop buying them, right? So you don't have to set up a reserve. So some products, so a company establishes a reserve for that, and that is very much an estimate, right? And that estimate can be based on past history, on past performance regarding the warranty reserve. But again, it's an estimate. So the auditor will look at that to ensure that that estimate, the estimate that the company developed is reasonable given the basis or assumptions that they used to develop that reserve. So those are the management assertions. Again, they're the same assertion with different focus. I said before, the key assertion would be completeness. And the concern here is that liabilities are reported, not recorded, or they're recorded in the wrong period. So those are going to be two key tests that auditors are going to perform related to this area. So for example, with search for unreported liabilities, auditors we look at receiving reports and test that match receiving reports near year-end and right before year-end to determine whether or not the items were recorded in the right period. They could look at cash disbursements made, subsequent cash disbursements, to determine whether or not that cash disbursement, even though it was made in January, actually whether or not it related to goods that were received before year-end or before year-end or after year-end. That is recorded in the right period. So let's take a look at walk through a problem. Problem 841, which deals with assertions, test controls, and possible errors and frauds. And that is 841 is on page. It starts on page 347 and extends to page 343. So there are four, on page 347, there are four questions, internal control questions, and then the requirements are on the bottom page. So just answer A, B, and C. Don't worry about this exam procedure. A, B, and C. To each of those four internal control questions. And remember, Exhibit 8A1 contains the internal control questionnaire, so that should help you think through the assertion that it relates to. Let's take a look at these. So, what does the first control question deal with? Are purchase orders above a certain level approved by an officer? Yeah, so it's one, it's accuracy. What's the objective here that you're trying to determine? So what's the fraud that could occur? Right, so this appropriation of assets or a duplicate report through recording purchases that are not valid. So what kind of test would you perform to test the control? Because the control is that purchase orders above a certain level should be approved by an officer. So the problem with analytical procedures is your objective here is to determine whether or not it's been approved, right? So purchases above a certain order. Right? So you could look at, if you try to test that control by performing analytical procedures, and really what you're performing there is a substantive test, not a test of control, right? So if you looked at the difference between purchases in year 1 versus year 2, what if you see no difference? That doesn't tell you anything about the control. Yeah.
Take a sample of purchase orders and then basically check if those purchase orders are above a certain threshold.
Right. Right. So that's why, because what you're testing, what you describe as a substantive test, which is good to look at, like if you just want to see if there are any, not necessarily controls, but if you want to see if there's any significant fluctuations from year 1 to year 2. So you would have some expectations, right? Your expectation might be, let's say you're looking at expenditures for repairs and maintenance. So your expectation might be, well, repairs and maintenance, it should be pretty flat from year 1. There's nothing that occurred that would suggest that it should fluctuate. So that's what that would tell you, right? If you did the comparison and you see that it's pretty flat, then you probably conclude that, repairs and maintenance, there's nothing significant going on. Versus if you looked at it and there was a spike in year 2 and there's no reason for that spike, that's a red flag, right? So you want to look at that account further. But that won't give you any information about the control. So you would select a sample of purchase orders, and over a certain threshold, whatever, if the threshold is 10,000, you would then look to see that all, those purchases over 10,000 in your sample had the appropriate approval, because you're testing the control. Yes?
So what's the assertion accuracy?
Yeah, well, it says accuracy could also be occurrence. That's probably closer. Probably is more indicative of occurrence. But if you're thinking about if you determine that the control, for example, that transactions below, let's say transactions below 10,000 doesn't have to be authorized. Only transactions over 10,000, you could look to determine are they accurately complying with the policy. But it's occurrence is probably more related to. What about number 2? Are the quantity and quality of goods received determined in time of receipt, so on and so forth? What's the assertion there? Okay, so let's talk about this first. So your objective here is that someone to ensure that the quantity is met, that the quality needs to come, you know, so it's not, you're not accepting damaged goods. You're only accepting goods based on the quantity reported in the purchase order. And you want that done, right, it has to be done independent of the purchasing department. So let's talk about completeness. Completeness is that everything that should be accounted for has been made. So we can't tell that, can we tell that from this? Right, but when we're thinking about completeness, we're not thinking about, you know, we're thinking more about the transaction itself and not the, right, that there was a purchase and that purchase has been accounted, reported that purchase. Here you're looking at the specifics on the invoice or on the shipping document that the vendor sends you, right? So you're just really looking at the detail to make sure it's consistent with what you ordered, right? So that's why we need completeness. In terms of valuation, valuation is really dealing with the account axis, right? The amount that's reported in the account, not on the invoices, but not on the shipping bill of lading itself, right? So here, what you're doing is, I get a bill of lading, and it comes to the receiving department. The receiving department should be comparing that against what we ordered, so the purchase order. Right. But we're just checking the detail. We're checking that if they ordered, if we ordered 10, we received 10, and those 10 that we received were good quality. They're not damaged. Say we fade it out at the end.
You would go through a sample of invoices and make sure that the receiving report, right? So you're going to do bill of lading or invoice. It could be that the vendor sends you an invoice. Whatever document that the vendor sends you, right? You want to compare that against what you're receiving, what you ordered. So you would select a sample. Now so what you just described is what the receiving department should be doing, right? They should be taking when those receiving reports come in, or the goods come in, they should compare what they received to what they ordered, and review the quality of those goods, right? That's what the result. How do you test that they're doing that? So you started out right. You take a sample of receiving reports and look for goods are probably gone by now. By the time you come in and do the audit, you're looking for evidence that they did. Right. So on the receiving report, there should be indication that they did. Right. There should be a if I'm you know the warehouse worker that receives goods and I did my job, I'm going to initial it. And then the other thing you would do is test it yourself. So you select a sample, look for indication, the signature initials that they did it, and then check to see that it's just not merely a signature, that it actually does agree. Right? So you would, as the auditor, test to make sure that, yep, the quantity agrees to the purchase order, well, you can't really test the quality, right? But because the goods are probably gone at that point. But just to see the indication that they're actually performing the control procedure. So, or you could observe. Even if you didn't, so that would probably be the best way, is to just kind of happen up on the, receiving department and kind of just observe what they're doing and see if they're actually opening the goods and that they're tying into the purchase order. I just have a side question, because while I was doing this exercise, I was trying to get one of the exhibits for the internal control questionnaire. And like the things that I was finding, like the questions were the same, but it's not compliant to what you're saying. So I just wanted to know.
What do you mean it's not compliant?
Because like, for
have, is not matching what I have.
Oh, okay.
That's what the problem is. I'll make a note of that. It's not matching what I'm looking at. Yeah.
I was gonna ask you if studying by the exhibits was a good idea, but now I'll go.
Yeah, that's a good thing to point out. It's not matching what I have here. That's not good. Okay. That's the first time I've ever noticed that. What I refer to in the solutions manual is incorrect.
Oh, okay.
Yeah, that's the problem.
So
So you should follow what's in the exhibit, because the exhibit is exactly what, we have the same exhibit. It's just that, and I noticed another error on the solutions manual as well, so I'll make sure to change that before I post the solution. So I'm sorry, occurrence, for number 2. Yeah, the test would be the same. The test would be the same. You're going to select a sample, right? Because what you're trying to determine is whether or not the quantities and the quality agree. Okay, to what, well, not the quality, but rather the quantities agree to the purchase order, right? Because you want to make sure that you're not, so say for example, the vendor, you ordered 10 widgets, but then when the receiving department gets the goods, it's 100. Well, the vendor is going to bill you for 100, but you didn't order 100. So they shouldn't be accepting that, or there should be some mechanism to alert the purchasing department or accounts payable that you received more goods than you ordered, so that they can contact the vendor and say you shipped us too many goods. Right? You can. So that's the point of it, is to make sure that you're not being sent items that you did not order, right? So that's why you want to. That's why the control is to compare the invoice or bill of lading that the vendor you received with the vendor shipment to your purchase order. So to ensure that you're not paying for something that you didn't order, and then you want to observe it for quality to ensure that you're not paying. You're not taking damaged goods, because you could get, sometimes things can be damaged in transit, so you don't want to pay for something that's not usable.
Would that be conducting any inventory?
Well, no, not necessarily, right? Because at this point, you would conduct an inventory account after you've updated your accounting record. So, periodically you conduct an inventory account. Usually you see it conducted certainly on an annual basis, but depending on the type of business, they might conduct it on a quarterly basis. But at this point, you're just checking before I update my accounting records. I want to make sure that what I'm updating is correct, and that I'm not, accepting goods that are not usable, because I can't put those in inventory. So your inventory account is after the fact. Okay, so what about number 3? Are vendor invoices matched against purchase orders and receiving reports before liability is reported? Yes. It should be occurrence, right? So if you look at our vendor invoices reconciled, I'm sorry, I'm looking at the wrong one. Okay, I'm not doing a little bit on this. reconciled, vendor invoices reconciled, against purchase orders reconciled, matches the same thing. So what could happen if it's not? If that control is absent, what's your risk? What's the error or fraud that could occur?
Reporting expenses with the liabilities without receiving.
Right, or incorrect amounts, right, if you're not matching it. Okay. All right, so how would the auditor test this? That would support the disbursement, right? So that would.
So when you select a sample of the liabilities that you reported, and then go back, trace it back to the documents, the receiving reports, and also the purchase order.
Right, so you can select the vendor invoices, right, and a sample of vendor invoices from your accounts payable. Your detailed purchase journal, for the purchase journal. So you can select a sample, or select a sample of purchase, and then title it back to the vendor invoices, or the vendor invoices probably better, and see if they match that they match the purchase order and receiving report. And you would look at the dates, right? Because what's going to be, you want to make sure that it's reported, that you don't update the liability until you've received the goods. So dates would be important. But another thing, a lot of what you can do with internal controls also is observe the process. Observe people performing the process. And you want to do it on a surprise basis, obviously, right? Observation is not the only thing, but it's a starting point, right? You could look to see how people are conducting their jobs, to see if it's something that they just naturally do. Most times, when you don't want to announce that you're coming, right? Because obviously, if you tell the shipping department, oh, we're going to be in here, the warehouse, the auditor's going to be here and they're going to be checking what you're doing, so make sure you do what you're supposed to do, then that's what people are going to do. So observation is a good way to see if things are occurring, but you also want to follow up with looking at documents as well. Previous documents that have been already reported, to see whether or not they're adhering to the policy on a consistent basis. Okay, and then the last one is, are journal entries authorized at appropriate levels? What's the assertion there? Right. So what's the error that could occur, or the fraud that could occur? So what's one of the things I talked about with journal entries?
Wouldn't probably be able to enter in fixed sales and
Right. So they could do that, but also one of the major concerns that one of the big risks with journal entries is topside journal entries. They're really, when you think about it, journal entries, most of in a computerized environment, your journal entries are based on updating from the subledgers, right? The purchasing. So if you look at accounts payable, right? The accounts payable should be a number, right? On a monthly basis, you'll see accounts payable updated based on the purchasing journal or debt credits to accounts payable based on the cash disbursements journal for trade, right? For trade accounts received, for trade accounts payable. So really, you don't expect to. So a lot of your journal entries are going to be based on your monthly processing and coming from those subsidiary ledgers or journals, subsidiary ledgers or journals. So what you're looking for as an auditor, that's what you could scan and determine, are there topside journal entries? That meaning journal entries to those accounts that are not coming from a subledger or another or a journal, right? Or that's out of sync on a monthly basis. Because then you're concerned about those types of things, that fraudulent or management's overriding controls, or that fraudulent activity is taking place. Because so journal entry, the examination of the general ledger for topside journal entries are a common way to test to look for fraud indicators, because you really shouldn't see a lot of topside journal entries. Now, that's not meaning that not every topside journal entry is going to be a fraud, but at least you won't, as the auditor is going to raise a red flag, and you're going to inquire about why those journal entries are being made. And most times management will have a valid reason for why they're going to make a topside journal entry, why they're making a topside journal entry. Okay. All right, so how would you test this? Right, so, right, you're going to check, you have to check signatures, right? The controls that they're authorized. So you want to look for evidence of authorization. So you're going to select a sample of journal entries, right? And determine whether or not they're properly authorized in accordance with the company's guidelines. Okay, so let me, the key, as I said, completeness is one of the key assertions in this cycle, right? And that's due to unreported liabilities, or assertion for unreported liabilities. So what you have to think about in the expenditure and acquisition cycle is the fact that there are accrued expenses, right? So companies accrue expenses all the time, especially at quarter end, month end, year end, right? There are accrued expenses. So those are where, an auditor is going to want to look at to determine whether or not accrued expense, whether there's an unreported liability. So one way that the auditor does that is obviously they know the client, so they know what types of expenses are normally accrued at year end, and they look to see if there's some fluctuations. So for example, you might start off by looking at those accrued expense accounts by performing just a simple analytical procedure to determine whether or not there's been any changes in accrued expenses, and should there be the changes in accrued expenses. So let's say, for example, accrued liabilities went down significantly from year 1 to year 2. So that might be an indication that they did not report a standard accrued expense, such as payroll or rent, or insurance, not insurance, but some type of accrued expense, right, that occurs at year end. So you would then go inquire with the client, but then look at the account in more detail to determine. So for example, let's just say it's rent, and they have to pay their rent, and they accrue the expense because the rent is due on January 10th, but they have to account for that portion between December 11th and December 31st, right? So let's just say that's a significant number. So there should be an accrued expense for that, right? Because they haven't paid it yet, but they will pay it in the subsequent year, but it's an expense that belongs in this year. So some portion of that expense belongs in the current year. So if you know that, so the auditor will go and, for example, look at rent expense, because they know or calculate their monthly rent is X, and this is all that they're showing in the account, right? So they're not showing the correct portion of rent, right? So the auditor would then know that that's an unreported liability that they should report and propose an adjustment debit, rent expense, credit, accrued liabilities to reflect that expense. So one way to try to identify some unreported liabilities is just to look at changes in the accounts from one year to the next, because some certain accounts follow a particular pattern. Another common accrued liability is payroll expenses, right? And that's because you have the same situation where an expense is not going to be paid until the following year, but there's some portion of that expense that should be accrued for in the current reporting period. And so auditors will look at the different expense accounts where they know that there are potential accrued liabilities that should be reported, and evaluate those accounts to determine whether or not the accrued liabilities are properly stated. So here are some examples: prepaid expenses, accrued liabilities, inactive accrued payroll, accrued rent expense, different types of expense accounts, inventory, and PP&E. And so, in looking at accrued liabilities, and why I want to talk about this, is more difficult than accounts payable. Because the difference with accounts payable is that you're being invoiced, right? The vendor invoices you for goods that you purchase or service that they provided you, right? So you have third-party documentation about that. Whereas accrued liabilities, those items have yet to be billed, right? But yet and still the client has incurred the expense. So based on GAAP, they should be recording that expense in the current period. Right? So that's what makes it a little bit more difficult. And so as I pointed out, substantive analytical procedures are one way to try to determine whether or not there's potentially any unreported liabilities, and just all other substantive procedures, such as you could actually confirm significant accounts, right? Because that'll tell you whether or not if you say to a vendor, ask a vendor to confirm an account, and the client has it on the books as, let's say, $100,000, and the vendor comes back and says, oh no, they owe us $150,000. If it's indeed that they didn't record a receipt, right, of goods, then that's the accounts payable is understated by that $50,000 for that vendor. So those are some examples of how what you're interested in is identifying. The goal is to identify liabilities and expenses that should be reported in the current period, but haven't been, right? And so that to ensure that liabilities are reported and expenses are reported at the right amount. Okay, so I'm going to stop here.